Hello and welcome to the day ahead. It is Monday, March 21st. I'm Andrew Gagan. Well, it was a risk rally week last week as investors brushed off the crisis in Ukraine and a more hawkish US Federal Reserve. Wall Street extending its rally to post its biggest weekly gain since 2020 on the back of the first rate hike since 2018, alongside a recovering oil price which briefly topped $130 a barrel before pulling back to hover around the $110 level. For the week, the Dow rising around 5.5%, the S&P more than 6%, and the Nasdaq soaring over 8%. Hopes of a diplomatic solution between Russia and Ukraine also helped drive that sentiment. Treasury yields were higher, though the 10-year eased as investors completely ignored a raft of Fed speak. Fed Presidents Waller, Barkin, Kashkari and Bullard all calling for more aggressive action should inflation continue to boil.
Central banks still need to tighten to make sure they stop inflation expectations rising. And that, I guess, is the main risk here. We've got much higher inflation than we've had at any time in the US over the last 40 years or so. Inflationary expectations so far have stayed relatively subdued, at least the longer term inflation expectations, but they could start rising. The longer these inflation numbers remain high, and we're seeing a build-up of supply constraints or supply concerns, if that continues, then inflation expectations will rise, and it's going to take more than 7 or another 3 hikes, 10 rate hikes. It's going to take more than 10 rate hikes to get inflation back under control.
Looking ahead, it's all eyes and ears on the FOMC Chair Jerome Powell taking the stage on 2 separate occasions this week, with the market paying close attention to the messaging. Elsewhere in the bond market, investor fears of a default by Russia eased after key debt repayments were made, showing the ability for the Kremlin to move funds abroad. However, risk remains in the credit markets. China tech stocks staged a bewildering recovery amid hopes Beijing will continue to take measures to support the economy, while President Xi told President Biden his top priority is now to continue the dialogue and cease fighting to end the war as soon as possible, but stop short of laying the blame directly on Russia. Briefly in Europe, London continuing its winning streak, up for its 5th session in 6, though remains below pre-war highs. A fairly quiet week on the macroeconomic front, or at least today. US existing home sales for February fell a more than expected 7.2% for the month, the leading economic index rising 0.3% month on month, in line with expectations. The Australian 10-year yield falling from 2.65 to 2.58%, and markets have fully priced a rate hike in for June. On the currencies front, analysts expecting the US dollar will remain heavy this week because historically the start of Fed tightening is a catalyst for US dollar weakness. The Aussie dollar rising from 73.75 to 74.18. It's expected to maintain its strength, although could face resistance at 75 US cents. So to the start of the trading week locally in ASX futures, they are up 0.8%, indicating Friday's rally on Wall Street will buoy sentiment here. A signal cautious optimism will continue after the market ended its best week in more than a year. Commodity price strength has returned, with Brent crude oil futures rising more than 1% to $108. Copper and gold are both up around 1%, and iron ore rising 3.5% to move it back above $150 a tonne. And on Friday, nickel fell close to 12% to finish the week down 23%. In the crypto complex, the top tokens have lost some ground in the past 24 hours, but over the past 7 days, Bitcoin up 7%, while Ethereum is up close to 13%. Looking to the day and week ahead for us here at home, and the Russia-Ukraine conflict remains front and centre, with news this morning Fonterra will exit its Russian businesses, withdrawing from the company's joint venture with Unifood, closing its office in Moscow and redeploying staff where possible. On the data docket, relatively quiet this week, with ANZ Roy Morgan's weekly read on sentiment released tomorrow, the second last index ahead of the federal budget, followed by detailed job vacancies for February on Wednesday and detailed labour market estimates on Thursday. And that is your day ahead. See you again tomorrow.